Well, this isn't surprising. It's confirmed. We are in a recession, if not many experts and news channels claim we are already in one. This will impact every American and any investments you have. So make sure you give this video a like, because I have done my research, so you don't have to. If you didn't know, a news report just came out saying that the U.S. economy shrank in just the first quarter at a 1.4% annualized rate. There is a serious possibility that the U.S. economy is about to slip into a recession if it hasn't already. So is there any way to avoid this from happening, or at least be prepared to lessen its effects? Well, that's what we will be talking about today, and what the government is doing right now to attempt to fight a 30-year high inflation. Now, if you look back at the recession calendar and correlate it with the bear market calendar, you will discover that the stock market has a fairly spotty record of anticipating corrections. Did you know that in 6 of the recessions since 1900, a bear market didn't begin until after the recession was already underway? And in the case of the 7th recession, there was no corresponding bear market. That means that in just 18 of the recessions, 72%, the bear market predicted a recession by turning down in advance. While 72% seems like an impressive track record, it's not exactly the full picture. Basically, it doesn't reflect instances in which there was a bear market on Wall Street and a recession did not occur. Of the 37 bear markets since 1900, 13 did not enter into a recession. Interesting, right? Taking all bear markets since 1900 into account, the stock market anticipated a recession in fewer than half of those cases. The bottom line, the stock market has a spotty record at predicting recessions. But recently, it has been ugly days on Wall Street, with stocks going from one of their best days in recent memory to one of their worst. Not something any investor would be happy about. Also, the Dow fell by 1,063 points, a day after gaining nearly 1,000 points. The S&P 500 and the tech-heavy NASDAQ were not left out on this, as they suffered similar swings after they had one of their best days since 2020. This event is a demonstration of the incredibly volatile markets and the continuous fear that we might very well be headed into a recession as the Federal Reserve continues its aggressive fight against inflation. Even the head of U.S. equity and quantitative strategy at Bank of America Securities, Savita Subramanian, has said that we need to prepare ourselves for a volatile market, stating that for the last 30 or 40 years, we have seen rates slowly plunging down to zero, and we are headed now to the opposite of that. But first, it is important to mention what the Federal Reserve is doing, because unlike what most people think, the goal is not to make the stock market go up so you can post your profits on Wall Street bets. Instead, the Federal Reserve is what is known as the central bank, whose role is to oversee our economy, regulate financial institutions, and control the supply of money into and out of our system. Their priority over everything else is to ensure we have a strong labor market, we have maximum employment levels, and inflation doesn't one day lead to us paying $50 for a loaf of bread by 2030. Now, they have made it clear that they intend to raise rates and tighten their policies to reduce the demand and prices of goods and services. And so on March 16th, they announced their first rate hike of 25 basis points. Even though that might sound like a huge rate increase on paper, mortgage rates quickly shot up to 5%. The stock market tumbled on concerns that the Chinese lockdown could make U.S. inflation even worse. And now, it's all but confirmed that we would see a 50 basis points rate hike throughout the rest of the year, potentially causing prices to continue falling. And that, of course, begs the question, how have similar rate hikes happened in the past? Well, here is where things get interesting. Paul A. Volcker, who became the chairman of the Federal Reserve in 1979, during the time known as the Great Inflation, was able to come up with a great rescue plan. He had the goal of bringing down inflation by announcing that he would start limiting the growth of the nation's money supply. As money becomes more scarce, banks will raise interest rates, limiting the liquidity available in the overall economy. However, the result was that interest rates quickly jumped to 20%, and the United States fell into a deep recession. Unemployment surpassed 10%, and stock and real estate values reduced. At least on the bright side, by 1983, inflation finally dropped below 4% as the economy began to recover. So that at least is a good sign, right? If you're enjoying this video so far, please tap the like button if you appreciate the research and time that goes into making these videos. Thank you. So, we are beginning to see that there are risks with rising interest rates, and with many more rate hikes planned throughout the year. Well, here is what you need to know. If we look through the past weeks, you probably would have heard the term soft landing. This refers to a gradual slowdown of the economy following a period of rapid growth, and as of now, that is the Federal Reserve goal. In a perfect world, the Federal Reserve can slowly increase interest rates, inflation will gradually begin to decline, and then the economy can begin to get back in shape. As we've seen in the past, rising rates have shown a series of effects on a mortgage. And as we can see now, mortgage rates have risen for several weeks straight, and now 30-year fixed rates stand at just over 5%. As a result, mortgage demand has dropped by 40%, and the worry is that home sales may begin to fall now that housing prices have hit record highs. On the surface, it makes sense that the higher interest rates go, the fewer homes people can afford, and as a result, the more home prices drop. But the more you begin to look at it, the more you realize it's not that simple. If we look back historically, we can see that after World War II, housing prices continued to climb right alongside interest rates. After that, rates dropped, and home prices increased even more. It was also found that overall, a change in interest rate does not substantially affect housing values over the long run, which means that most likely other factors have just as big an impact. For example, the homeowners who just locked in historically low interest rates might be less likely to move because if they sell, they would have to buy a new home with a higher interest rate than what they have today. So perhaps they should stay and live in a less inventorial and already constrained market. Even though it is true that higher interest rates directly affect home affordability, other factors like local market conditions, supply, demand, inflation, tax deduction, population changes, and the overall health of the economy play just as big a factor. So rising rates alone are not going to be enough to cause prices to decline. Let's talk of the ways this recession can impact the stock market. Well, here's where things get interesting. From 1869 to 2018, there have been 16 recessions with a positive stock market return. In fact, during these positive recessions, the market went up an average of 9.8%, while the GDP declined by 3%. Out of 30 recessions, half of them did not correlate with the stock market. To take this a step further, since 1869, one study found that the correlation between GDP growth and stock market returns was nearly zero, at 0.05%, and on average, the stock market tends to pick 6 months before the start of a recession. And that is where we get some of the bad news. Throughout every recession since 1945, the stock market has seen a sell-off with an average drawdown of minus 29.2%. However, the good news is that even though there can be a rather abrupt sell-off, by the time the recession is over, the market recovers and poses an average profit of 1.7%, with an average gain of 15.3% in the following year, meaning investing during the recession is one of the most profitable times you can be investing. Not to mention, in the 3 years following every single recession we have ever had, the market was 100% in the green. But take note, it is not as easy as it sounds, because most of the time, people don't know we are in a recession until it's too late. Since technically, a recession is defined as 2 negative periods of GDP growth. We could be at the start of a recession right now with one of them already on our belt. In this case, seek a market structure that most of the time the market sees peak pains 6 months before a recession, because for the most part, the stock market tends to be forward-thinking. If anything, Bloomberg notes that a bear market tends to be a better predictor of a recession, rather than a recession being a better predictor of a bear market. But according to the White House, they say the inflation we are seeing today is very similar to what happened after World War II. This was concentrated in the supply disruptions and demand after a period of temporary suppression. And in 1956, it was said that the inflation episode ended after 2 years as domestic and foreign supply chains normalized and consumer demand began to level off. But with the Federal Reserve having a history of hot landings in the market, I think the best thing we can do is to have a consistent income and to stay as minimal as possible in our spending and consumption. Only take a fixed rate debt if you buy a house or a car, and only buy investments you plan to hold for 7 to 10 years. Also, based on every recession in the past, the best course of action is to stay invested and keep investing when times are bad, especially now that we are in a recession. Just expect that stock market volatility to continue during these unpredictable times, and anything could really happen. It's always a good idea to do your best to stay employed and understand that no recession has ever lasted for longer than 18 months. With that being said, Hopefully you enjoyed the video and are now caught up with what's happening in the economy. This video took a lot of work, so if you can, hit that like button and make sure to subscribe for more personal finance and investing videos.